Hey everyone, and welcome to This Explainer. Today we're diving into the fascinating push and pull of progress that is completely defining India's economic landscape right now in April 2026. On one hand, we're seeing this aggressive, record-breaking economic growth paired with some seriously amazing digital conveniences. But on the other hand, regulators are throwing down incredibly strict security measures and tight structural rules just to keep the whole system from flying off the rails. It's literally a massive, high-wire balancing act, and we're going to break down exactly how it's all playing out.
Okay, let's dive into this. Here is our roadmap for the explainer so you know exactly the path we're taking through this dense material. First, we'll look at the macroeconomic picture, then move into banking and RBI updates. After that, we'll tackle digital fraud and cybersecurity, followed by SEBI reforms and market rules, and finally, trade and insurance shifts.
All right, Section 1, the macroeconomic picture. Let's look at the high-level forces driving India's economy right now.
So the World Bank just released their biannual regional economic updates, and they've officially raised India's growth forecast for the 2026 to 2027 financial year to 6.6%. That's a solid increase of 0.3% from their previous estimate. To put that into perspective for you, the rest of South Asia is projected to grow at around 4.1%. This proudly solidifies India's position as the fastest-growing major economy in the world today.
But wait, despite that blazing 6.6% growth, we have another number we need to talk about: sixth. In a pretty unexpected twist, India has actually slipped to the sixth spot in the latest IMF Global GDP rankings, sitting just behind the United States, China, Germany, Japan, and the United Kingdom. So how does the fastest-growing major economy suddenly lose its rank?
Now, what's really interesting about this is how we decode these seemingly contradictory data points. The slip comes down to a C grade from the IMF. Why the low mark? Because the national GDP valuation was based on a severely outdated base year from 2011. Combine that outdated data with the currency factor. Since the IMF ranks GDP strictly in US dollar terms, the recent depreciation of the rupee against the dollar artificially lowered India's relative valuation on the global stage. So the growth is absolutely real, but the direct translation into dollars is what caused the slip.
To navigate all this global and domestic economic uncertainty, the RBI is holding steady. They are maintaining a 5.25% repo rate, keeping a strictly neutral policy stance. Looking ahead, they're projecting a very optimistic 6.9% GDP growth for FY27, with inflation sitting at around 4.6%. By staying neutral, the RBI is basically keeping its options open. They aren't tightening or easing aggressively. They're just pausing, watching the data closely, and keeping a very close eye on potential inflation spikes from things like crises in West Asia.
And speaking of that currency depreciation we mentioned earlier, the RBI isn't just watching from the sidelines. They're actively stepping in to defend the rupee. How? By urging public sector oil refiners to completely stop buying US dollars directly in the spot market. Instead, the RBI wants them to use a special credit facility routed through the State Bank of India. This acts like a foreign currency line of credit, which effectively delays that immediate massive domestic demand for dollars, helping to stabilize the exchange rate.
Let's transition over to Section 2, Banking and RBI Updates. Let's see how these macro trends are directly impacting specific financial institutions. First, we need to break down some financial jargon and look at a key banking metric called the CASA ratio. This is simply the share of a bank's total deposits that are sitting in low-cost current and savings accounts. Right now, it has fallen to a two-year low of 37.9%, down from over 40% just a couple of years ago. What this tells us is that everyday customers are getting incredibly smart with their cash. They're actively shifting their money out of everyday checking accounts and locking it into higher-yield term deposits for better returns.
And this brilliantly illustrates a massive shift in corporate power happening at the exact same time. State Bank of India's market capitalization has surged to over 9,04,000 crore rupees. Meanwhile, ICICI Bank recently suffered a sharp market correction of over 10%. Because of this, SBI has officially surpassed them to become India's second-largest lender by market value, sitting just behind HDFC Bank.
While all this shifting is happening, the RBI is keeping a notoriously cautious, tight leash on lenders. For instance, Ujjivan Small Finance Bank tried to upgrade its status to a universal bank, but the RBI sent the application right back. The reason? Their loan portfolio just wasn't diversified enough to meet the strict criteria. On top of that, the RBI is tightening the net on massive non-banking financial companies, or NBFCs. They've simplified the rule down to this: if an NBFC hits a strict 1 lakh crore rupee asset threshold, they are identified as an upper-layer NBFC and subjected to heavy regulation.
Even state-owned NBFCs like NABARD and Exim Bank are no longer exempt from this strict oversight.
Moving right along into Section 3, Digital Fraud and Cybersecurity. This is where the explosive growth of digital finance meets some terrifying new threats.
First up, let's talk about the incredible push for user convenience. The RBI is making everyday transactions beautifully frictionless. You no longer need an OTP for autopay mandates up to 15,000 rupees. And if you're setting up mutual fund SIPs or paying insurance premiums, that OTP-free limit has been massively raised to 1 lakh rupees. It's all designed to make recurring digital payments completely seamless.
But let's see how this builds into our next crucial point, because that seamless convenience comes with a very dark side. Last year alone, a staggering 22,000 crore rupees was lost to digital fraud in India. This danger has created a desperate need for the RBI's new tech thriller-style defense mechanisms. To stop fraudsters, the RBI is proposing a mandatory 1-hour delay on the first transfer over 10,000 rupees to a new beneficiary, giving you a crucial window to cancel a fraudulent payment. Furthermore, seniors aged 70 and above must nominate a trusted person to approve any transfer over 50,000 rupees. And perhaps the ultimate tool, banks must provide an instant kill switch, a single step allowing customers to immediately disable all their digital payment channels if they suspect they've been compromised.
So why such extreme measures? Well, because the threats are evolving at breakneck speed. The RBI is currently deep into analyzing Anthropic's new AI model, known as Mythos. Their preliminary assessment warns that advanced AI models like this could rapidly accelerate the discovery and exploitation of vulnerabilities in India's payment infrastructure. There's a very real futuristic fear that this could lead to massive breaches of India's strict data localization rules, which mandate that all transaction data be stored entirely within the country.
All right, let's move into our fourth pillar, Section 4, SEBI Reforms and Market Rules. Let's examine how SEBI is keeping the playing field fair and transparent. SEBI is currently walking this really fine line between strict oversight and procedural fairness. First, they've amended the fit and proper framework for market intermediaries. Previously, just the mere filing of an FIR could get someone automatically disqualified. Now it requires an actual conviction, which protects people from being unfairly penalized by mere allegations. But at the same time, they're aggressively closing loopholes. Shares that are locked in after an IPO and then pledged as collateral are now explicitly tagged as non-transferable, ensuring those lock-in rules absolutely cannot be bypassed. And to oversee all this, SEBI just launched 3 brand new IT platforms, including a really cool AI-enabled system called CSAC, specifically built to analyze cyber audit reports and spot compliance gaps across the market. We also got a very interesting clarification from SEBI regarding mutual funds. They explicitly ruled that private family trusts are entirely banned from acting as sponsors for mutual funds. Sponsoring a mutual fund is strictly reserved for a body corporate. SEBI's logic here makes total sense. A body corporate structure ensures far greater transparency, strict legal accountability, and adherence to heavy regulatory standards compared to the pretty opaque nature of private family wealth trusts.
Now we enter our final thematic section, Section 5, Trade and Insurance Shifts. Let's start with a totally brilliant financial innovation for social good, ZCZBONDS, or Zero Coupon, Zero Principal Instruments. Think of this not as a traditional investment, but as a formal, transparent donation mechanism for not-for-profit organizations listed on the Social Stock Exchange. You get zero interest, and you don't even get your principal back. To help these NPOs raise money much more easily, SEBI has significantly lowered the minimum subscription requirement for issuing these bonds from 75% down to 50%, and individual investment limits have been slashed to just 1,000 rupees.
So the crucial point is that, on the absolute opposite end of the spectrum from a 1,000 rupee donation, we have the behemoths. 3 massive insurers, LIC, GIC Re, and New India Assurance, have officially retained their status as DSIIs. That stands for Domestic Systemically Important Insurers. They are, quite literally, too big to fail. Because their collapse would completely devastate the broader financial system, the regulator tags them as DSIIs and subjects them to the absolute highest levels of regulatory monitoring and the strictest capital norms out there.
Finally, let's talk about physical wealth, gold and silver. India is one of the world's largest importers of precious metals, and that puts a massive strain on our current account deficit. To tightly control this massive inflow, the government has explicitly restricted bullion imports for the 2026 to 2029 period to just 15 authorized banks. Interestingly, Within this small group, Sberbank and Union Bank of India were given exclusive, special allowances for gold imports. This entire policy isn't just about paperwork. It's engineered to ensure perfect traceability, tightly control the domestic supply, and absolutely crush illegal smuggling to protect the country's macroeconomic stability.
We have covered so much ground today, from the macroeconomic push of world-leading growth down to the pull of tightening bank regulations, the rise of digital conveniences, and the very real threat of AI-driven fraud. And it all brings us to one vital, provocative question. As AI models evolve and global markets shift under our feet, is India's regulatory net strong enough to catch the next big disruption? What we are witnessing is a delicate, high-stakes balancing act between relentless progress and absolute necessary protection. Thank you so much for joining me for this explainer. Keep asking questions, stay curious, and I'll catch you next time.